For generations, the ultimate financial milestone for families has been holding the deed to a fully paid off house. But locking your wealth inside those four walls might actually be the single biggest trap keeping you from serious net worth accumulation. Right now, in May 2026, the cost of borrowing capital has stabilized at a higher baseline. The average 30-year fixed-rate mortgage is sitting right around 6.37%. Compare that liability against projected returns. Wall Street forecasts an average 12% S&P 500 return this year. The spread between 6.37% debt and 12% growth is what wealthy investors seek. It's mathematical arbitrage, exploiting the gap between fixed liability and compound growth. And if you are one of the millions of homeowners who locked in a sub-3% mortgage rate back in 2020 or 2021, your spread is historically massive and incredibly difficult to replicate. Every dollar you use to pay down a low-interest mortgage provides a return exactly equal to the interest you saved, a guaranteed no-volatility gain. Choosing that 3% savings when the market expects 12% is the mathematical equivalent of buying a low-yield bond. It prioritizes psychological comfort at the direct cost of compounding your net worth. Of course, gross returns on a spreadsheet don't tell the whole story. To calculate the actual profitability of market investments, we have to account for tax drag. Index fund profits leak through federal taxes, specifically the 15 to 20% long-term capital gains tax, and for high earners, an additional 3.8% net investment income tax. But the math shifted in 2026. The One Big Beautiful Bill Act turned temporary provisions into permanent law, changing how the IRS treats your debt. The new law increased the state and local tax deduction cap to $40,400, pushing many households into itemized reporting. This makes mortgage interest heavily deductible, effectively slashing that 6.37% loan down to 4.5%. The current tax code subsidizes your mortgage debt while penalizing your investment gains. To know if arbitrage works for you, you have to calculate your exact after-tax spread. There is an obvious variable here. The S&P 500 does not deliver a straight, predictable 10% return every single year. A fixed mortgage is mathematically certain. The stock market is volatile. This March 2020 chart illustrates sequence of returns risk. A severe market crash when you need cash devastates your net worth. Selling shares during the trough of this V-shaped drop means missing the recovery, crippling your portfolio's ability to compound. But timeline changes the equation entirely. Over a 3-decade span, the linear arithmetic savings of paying down a loan are violently overtaken by the geometric exponential curve of compound market interest. Market volatility guarantees you will experience short-term turbulence, but prioritizing the safety of a guaranteed mortgage payoff ensures long-term wealth stagnation. The reason people still rush to pay off their houses comes down to a behavioral flaw known as the endowment effect. Human psychology naturally overvalues a tangible, physical asset that we can sleep inside, compared to digital numbers sitting in a brokerage account. The opportunity cost is massive. Putting an extra $100,000 toward a 6.37% mortgage saves about $638,000 over 30 years. Investing that same money in an index fund yields around $2.1 million. Many assume they can just rely on a home equity line of credit if an emergency strikes, but equity is not cash. During financial crises, banks have the legal right to instantly freeze or reduce your credit line. If you lose your job and property values dip, the bank can lock you out of your own wealth. A paid-off house is ultimately just trapped, stagnant equity. A brokerage account provides absolute liquidity within 1 to 3 business days, giving you actual financial armor when you need it most. A 30-year fixed-rate mortgage functions as a strategic short position against the US dollar. Inflation acts as a silent ally to the borrower. Over decades, it mathematically devalues the purchasing power of the currency you use to pay back the loan, while simultaneously inflating the price of your market assets. This strategy requires precise execution. You have to calculate your personal hurdle rate, factoring in your specific mortgage lock-in, your income tax bracket, and how the new OBBBA deductions impact your bottom line. It requires abandoning outdated financial advice rooted in emotion. Every dollar you deploy should be directed by mathematical spreads and opportunity costs, not the psychological comfort of a zero balance. Wealth accumulation is a game of math, not sentiment. If you are ready to optimize your capital, hit subscribe and join us for more rich